Hey, welcome to the podcast, everybody. Thank you for joining me. Well, today's Friday. The stock market is closed. The bond market is closed, and got a lot to cover. We'll try to do it as quickly as possible. I know a lot of you wanted to see a podcast yesterday on that really nasty day. Had a board meeting last night, so I was unable to do that, but did want to get it out to you as quickly as possible right after the close today. And stock market a little mixed today. The small caps were up on the day, mid caps down on the day. The Standard & Poor's 500 up on the day, the NASDAQ down on the day, and the Dow Jones up on the day, and Treasuries again down on the day as yields climb to 2.5% for the first time in a while. And you can see here, we'll just jump right into it. Kind of broke through this upper end. We said that 2.4 looked like that was highly likely. Foregone conclusion, that happened, and just went right on through. And so kind of the next area I want you to look at is, and this affects a lot of your investments. So if you're somebody that says, well, I don't really, bond market doesn't really affect me. I just kind of do stocks or ETFs or mutual funds. It does affect you. It affects everything, and that's what's driving the market right now. But you can see what we have here is this is weekly. Now, so what this means is this red line's a 200-week moving average. May not be real relevant. I mean, probably not a lot of people look at 200-week moving averages, but you will notice every time in the past since '08 that we've reached this level, rates have paused, and here we are again approaching it, just a little higher than we are right now. So look for that to test next week, and then maybe you would see a reprieve. And I think you will. I think even if this was the bottom down here in the summer of 12, which was like 1.4% on a 10-year Treasury, you still have this pattern going on. This one is just a real big move, but it's not going to go straight up. That's not what rates are going to do. They're going to come back down, and then they may continue higher. But we've been talking about this lately. I think the cure for higher interest rates is higher interest rates. Now, you may be saying, What are you talking about? Can you speak English? Remember the old saying back when oil prices, let's take a look. Oil prices back in, I think it was 2007, 2008, reached $150 per barrel, and obviously dropped all the way down to the 30s. Well, a lot of people at the time were saying, what would, and the Fed believed this at the time, what is the solution for high oil prices? And the solution was high oil prices. Why is that? Well, because it gets to a point where it can't, the economy can't withstand that type of shock. And gasoline prices and oil prices went up so fast in '07 and '08 that whether it was coincidence or not, it went up, and then obviously the economy grinded to a halt, and that fell very hard, as you can see. So the Fed believed and still believes that the cure for some of these things is that they get to a certain level and people change their habits, the economy slows down, and those commodities come back down. That was the case back here. And so they always used to say, the old saying was, the cure for high oil prices is high oil prices. And I want to use that term today because I think the cure for high interest rates is high interest rates. So what that means is all of the housing data we've been hearing about lately being really good. People buying cars again, people buying houses, people refinancing. That stuff's picking up. And by the way, who's mainly buying the houses? This company, the Blackstone Group. The Blackstone Group is a private equity group. They are the largest homeowner in the country. So it's not just individuals buying homes. There's a lot of homes being purchased for investment purposes. So let's get back to rates for a minute, though. So the housing market was recovering while interest rates were down here, right? So interest rates have now started to climb. Now they're spiking up. So you have mortgage rates spiking up as well. So there's no doubt you're going to see mortgage refinancing slow down. I think you're going to see purchases slow down. In other words, this economy, I don't think this economy can withstand interest rates up at 4 or 6%. And the market's acting this week as if rates are going all the way back up here, vertical. That's not going to happen. Rates don't do that. So what happens is when these rates spike, you're going to see softer data. And what's that going to mean? That's going to mean the Fed while they may say they're going to taper, they're going to do it in I think, a slow fashion. I was surprised they gave the time frame because remember, they've already done this heavy lifting. The market has for the Fed, just by the fact that they've been kind of talking about it and there's been hints of it in the last few weeks. Interest rates have risen. I think Ben Bernanke, the more I think about this, I think the reason he released this is because and said that he had an exit strategy is because he wanted to have an exit strategy before he leaves. I don't think he'll be reappointed. That seems like that's a done deal now. Who knows who's going to replace him? There's a lot of speculation. But for right now, he's got to wrap this thing up. It may not be done, but he needs to come out and say, this is the way I'm going to get out of this. And he did. And that's why I think he said it when he said it. But it's kind of strange. It's as if right now you're looking at the United States on its own little island. Because you think about what's going on in China. China is having a banking situation, we'll call it. And their yield curve, and I don't want to get too technical for you guys, but their yield curve, meaning their long-term rates compared to their short-term interest rates, is inverted, meaning the long-term ones are up here, and their long-term ones are down here. Their short-term ones are up here, so it's backwards, and that signals stress in the banking system. So you have that going on. You still have Greece percolating again. Just in Europe, a lot of stuff going on. Emerging market stocks are really getting hit hard right now. This is a long-term picture of emerging market stocks. This is a picture of what's been happening lately. They've been getting hit really hard, and I actually think that might be an interesting little trade, but we'll get to that in a second. But anyways, they've been getting really hit hard, and meanwhile the Fed's saying, we're going to take our foot off the gas and everything's fine. And again, while they probably should start tapering at some point because we're not in a crisis, it was just interesting that they put this kind of time frame on it. But again, listen what they said, or what Bernanke said. He said, if this happens, if that happens, we will start to do it, later in the year into next year. So there's a lot of ifs. If this happens, if that happens. And, look, the data is going to, I think it's going to continue to be soft. And so interest rates are adjusting, and so what you're seeing right now is this adjustment from a world where we had like kind of a ceiling on rates to now they're adjusting the ceiling to a new level. Okay, so the ceiling was for the last couple of years somewhere in the 2.5 to 1.5 range, right, all the way from the summer of 11 until now. Well, now if you kind of zoom out a little bit, assuming that this red line doesn't hold, maybe the new range is 2 to 3 or 2.5 to 3. So the market's adjusting to that. And I think this is actually pretty interesting. If you're somebody that's living off of a fixed income, and you have your investments and things, there's going to be a lot of things that are going to start paying you more. But you have to have the reinvestment income to take advantage of it, or at least if you're in some funds or some things that can take advantage of it, don't sell them when they've been depressed, because there's been a lot of things beaten up in the last few days that produce income. So I'm actually excited about what's going on because I don't think this is a runaway interest rate environment. In fact, when people say that the end of the bond bull market is here because they see this, that may mean we're not going back down here, but they're not necessarily saying that we're going up here. Okay? All they're saying is that the capital gains are gone, meaning interest rates may not keep falling, down to 0.5%. They may just be done going down. So if you picture it like a clock, and you had this clock on the screen, we're at 6 o'clock maybe right now. And at some point they're going to start going up. But I don't think, there's always this perception that when rates go down, when they do turn, they're going to go straight up. And I don't think that's the case. I think rates could move sideways for a few years. Who's to say we couldn't get in a 2 to 3% range for the next several years? So you don't make a bunch of money on bonds, but you don't lose a bunch of money on bonds either. Everybody has this idea that you're either going to make a bunch of money on bonds as rates go down, or you're going to lose a bunch of money as rates go up. And I don't think that's necessarily the case. But so that's what's going on with rates. I think right now that's why Ben Bernanke did this. I don't think if you, again, going back to what I said the other day, if you look at the data that is coming out, it wouldn't suggest that he should be tapering based on their own assessment. Not what I think, but based on what they've been using. So given that, I was kind of surprised that they did what they did and said what they said. But again, Well, I should say what they said because they didn't do anything. Remember, they're talking about when they're going to do it, but he did say we're going to have low interest rates for a long time. So keep that in mind. But I think the one interesting thing about this is if you're somebody that's risk averse and sitting in cash, you earn nothing. So if you're somebody that's been sitting there in bonds and all you own is treasury bonds or something like that, now you're getting hurt there. So where do you go next? You go back to cash? Do you go to stocks? So again, it's really interesting to see who's being hurt in this economy, in this environment, and who's being helped. And but anyways, let's take a look at the stock market, and we'll take a look at the S&P first, as we normally do. We'll zoom in here. We talked about that 1600 level, and you can see it broke through it yesterday. And then we also talked about this next level down here at kind of we'll call it 1540, 1550 level, 1535, somewhere in that area. I don't like to get too technical. But basically, you can see it bounced off its 100-day moving average today. Today was a triple witching day, which sounds spooky and scary, but it's basically options and futures expiring at the same time, so you get a lot of volatility. Normally, after two 90% down days, which we had, this was a 90% down day right in here, and this was a 90% down day. When you have both of those, as we did right here and here, you generally want to see how does the market react the next day. Does it come back very strong with a vengeance and a lot of volume and so forth? And we didn't get that hard bounce today. The Dow was up 41. The NASDAQ was down. Mid-caps were down. So does that mean that it was a failed rally? Not yet. And it's because of the caveat that today was triple witching. So let's see what happens Monday. But you should get a stronger bounce. If we get a bounce, and let's say it's a lethargic one, we don't have a lot of internal strength in that bounce, I think what's likely to happen is you have the 20-day moving average coming down. You have the 50-day moving average. We could bounce right back up to that, which we'll call it 1620 area, something like that, and then we roll back over. I think that would be your time to add some hedges at that point. If, again, this is a big if we don't get that stronger sense of follow-through. So let's see what happens on Monday. But if we do break on down, then I think there is a possibility. Obviously, we could head down to these lower levels down here, because as of right now, it's been about a 5% correction, and there's nothing to stop it from being a 10% correction in this environment. I still believe in this environment right now, you must be in stocks if you want to be invested at all, because that's the place to be. Now, there's different kinds of stocks, right? There's technology stocks, there's energy stocks, there's utility stocks, there's REITs, there's different types of closed-end funds, there's business development companies, there's all different types, industrials, all different types of stocks to buy. So that's a broad statement to say stocks, but that seems to be the only place for investors. So I still like stocks. I think it's still a good stock market. There was massive distribution the last couple days, but I think it's a good stock market. We could be going through a choppy, nervous, volatile time for the next few days, even weeks, and you can see the volatility has picked up here a little higher than it's been recently, but nothing that was more than what we saw at the end of last year. So let's see if that comes back down. It was down. The VIX was back down below 20 today. So let's see if it starts to come back down again. But overall, we could be choppy here. But I think you pick your battles. You pick some things that you've been wanting. You go ahead and take a stab at those, and then some things that you've been wanting for income, as we've talked about the last several years, getting income. There's some things that are really more compelling now than they were literally a week or two ago. And so if you want that constant income, you can go buy those things now with a higher yield. That's very, very important. So I think it's interesting what's going on, and I think there's some opportunities out there as well. But we have to see the follow through. We have to see, is the market going to bounce from these levels or not? Because there were some times back in, let me zoom out here, back in 2012, where the market rolled over. In fact, I'll put it back on the daily picture. But back in 2012, we had a couple of corrections, if you recall. And one was in the May time frame, kind of like now. And we went down, and but before we even did that, there was a period where it broke. It looked like it was going down, and then it went back up, and then we fell, and it broke the 200-day moving average. Everybody was freaking out, and then it took off again, and up we went. Same thing happened later in the year. We broke the 200-day moving average, and then up we went. So, again, just because this trend that we've been in is clearly broken now, it's clearly broken, look for, potentially some, and I'll draw a little box, kind of the area that we're talking about here. But this is the area that, we could see the market kind of, and anywhere between there and the 200-day moving average, gyrate for the next few days. In fact, we need to put it over actually higher because it could bounce up and just be in this area and then eventually work itself out to where it goes higher because, again, where are a lot of investors going to go? They don't have a lot of options right now. If we take a look at the NASDAQ, which had been very strong, again, kind of in this uptrend, nothing really wrong with this. I actually still like tech stocks a lot, and so I really like what's going on there. Dow Jones, you can see it's kind of went through its 50-day moving average pretty quickly and is sitting on its 100-day moving average. And again, how do these things respond? That's what we're going to be checking for. So let's look at emerging markets. We talked about that just briefly a few minutes ago. This goes back a ways, and you can see emerging markets obviously bounced in 2009 like everything, had that horrible crash, came back with a vengeance, but it hasn't been doing much lately compared to the United States. Now, some people are very bullish of the emerging markets because they say, look, yeah, they've got their issues, but they're growing faster. They don't have as much debt as some of the developed markets. Some of them aren't manipulating their currencies or their markets the way others are. But it's a mixed bag. I think there's certain countries that are better than others, emerging markets. But overall, when you look at this, I've drawn a line. We're at a pretty interesting spot right here. And in fact, emerging markets bounced 1.4% on the day. But you can see we bounced all these different places here. And we bounced off of this again. So look for emerging markets to bounce off of here, which would be obviously helpful to the whole equity market. It's at a big inflection point. If it breaks through, then we could see much, much lower prices for emerging markets. But I think it's an interesting place to take a stab at a trade if you want, or if you're somebody that just wants a piece of emerging markets for a long-term, piece of the portfolio. This is not a bad spot because remember, these have fallen quite a bit here recently. I mean, that was $45 for the emerging markets ETF. We're now at $37, so that's about a 20% drop. Let's look at gold for a second. This is something that was setting up pretty nicely for potentially a trade as it kind of approached this area down here, and of course fell on through yesterday or 2 days ago with the announcement of the tapering potential. So it fell right on through because basically, look, we don't have inflation right now, and gold trades well when there's inflation, and there's no inflation right now. So it's going down. Now, gold also does well during times of fear, and yet it didn't do that yesterday. There was a lot of fear yesterday. So I tell you what's interesting about this market and what's difficult about this market. If you just look at the stock market here overall, the S&P 500, if you go back to the flash crash, if you go back to 2011, if you go back to any of these times when the stock market sold off, typically either gold or treasuries rallied when that happened. So people would shift assets. So if you had a little bit of some of that stuff, you were okay because something was going up. That's not the case in the last couple of days. Whether you had bonds, conservative or not, remember, even if you had short-term bonds, long-term bonds, if you had stocks, if you had REITs, if you had gold, all these different asset classes all went down, very reminiscent of 2008. That's why hedge funds did so poorly in 2008, because there was no place to go. And so the diversification was cash. That's where you went. This isn't a credit crunch like 2008. This is happening because rates are going up. Well, why are rates going up? Because the Fed thinks that the economy is growing better. And so, again, that should be good, right? But people want to see evidence of it first, and so they're adjusting. But that's what's hard right now is diversifying. There's not many places to hide, so you have to kind of live with what you have if you're not overweight in any one area. And so that's why I still want this balanced approach right now where you have income, you have some things for trades, you have some kind of core things that you want to keep, some fundamental buys, And then again, take a stab at some of those income things that have sold off. But I think if you have that balanced approach and you have some powder dry, you can take advantages once the dust settles, because I think it will. I just don't know how long it's going to last. But that's what makes it hard about you either sell the stuff and sit in cash, but you run the risk of a big whipsaw where you say, okay, it looks like I should be out, and then their stuff just runs up. And there was a lot of companies up today and up pretty strongly. So watch that. Also, I want to make one distinction here. Financials, which I like financials. I think they're setting up nicely, but I haven't bought them. But financials are, this includes everything, and they've been struggling. They were down again today. But when you look at something like the regional banks were actually up today, and they've been holding up quite nicely. And I think the reason why is if you think about big, huge banks, the Goldman Sachs, the Citigroups, Bank of America's, they have trading departments. They have regulations, a lot more regulations to deal with. They have all kinds of stuff that can be affected by higher interest rates, whereas regional banks, they benefit from higher interest rates because they're mostly in the lending business, the borrowing business, and so bank deposits are a big deal to them, and that spread is widening. What they lend versus what they borrow is widening. So financials look good, but regional banks look even better. So take a look at that. That's something I'm looking at right now, but I wanted to kind of give you a sneak peek at something I'm watching on a relative basis that's been very, very strong. And I need to do a little more research on some to figure out, do I want individual companies in that sector, or do I want the basket as a whole? But that's been one thing that was actually held up extremely well yesterday, was barely down on the day, and today came back, and the basket itself was up about 60 basis points, 0.6%. So that was interesting to watch that as well. And today what kind of came back was things like real estate came back today, utilities came back, telecom, pharmaceuticals. That's more of the safety trade. I think the bulls really wanted to see financials do well. They wanted to see tech do well, and we didn't get that today. So again, let's see if there's any follow-up there on Monday. By the way, getting back to bonds for a second, I want to make sure you understand what's going to happen here. People are going to see losses in bond funds, and they're going to start calling their fund managers and liquidating, putting further pressure. So that's why you're seeing kind of selling begets selling, because more and more pressure is being put on bond funds to sell those securities they own. So there may be some very compelling deals for you individually, but you may see rates continue higher for a little bit longer simply because of that selling pressure. But just to wrap this up, again, we are going through what I think is a correction, not the beginning of a bear market. And corrections technically can be anywhere from 5 to 20%. Now, I don't think we're going to go down 20%. This is only 5 and people are freaking out. But I do think we may have a little more downside to go, even perhaps to 10%. But ultimately, I think this thing will go higher. I'm not going to say that we're going to 1,800. I'm not going to make any end-of-year predictions because all those people that do that are wrong. I'm just going to say that I don't think this is the end of this run we've been on. And it's because we are still in I think for stock investors, a Goldilocks scenario. I think we're in a scenario where you have interest rates, while they're higher, they are still low. Overall, they're still at 2.5%. That's still very low. Number two, the economy is not in a recession, but lethargic. And you're getting mixed signals. You're still getting some good stuff. You're still getting some bad stuff. It's okay. It's just mediocre. And that's a good environment for stocks. And people don't want to be in the bond market right now, so guess where they're running? They're going to run to stocks at some point. But fear is driving a lot of things right now. And the fear of much, much higher interest rates, I think, is overblown because, again, the economy can't withstand that. So it's going to have to self-regulate. And by the Fed just mentioning that the market's doing the work for the Fed already. So I don't, the tapering, how long that takes, who knows? I think it is going to be data dependent, and I don't see the data being extremely good to have them say, yes, we need to exit this right now. But I think Ben Bernanke did want to get that out there so that he could say, hey, I started this thing, and I'm telling you how I'm going to wrap it up. He may not be able to wrap it up, but he's going to tell you, that was my plan, but now I'm going to exit out the door. All right, guys, that's a lot of information, almost a 30-minute podcast. Hey, keep the questions coming. Love the questions. I got some recently about QE and things of that nature. Don't forget, we're on eggerscapital.com, the money management website. There's a free subscription to get the podcast delivered to you, any blogs we do at karleggers.com. We're on Twitter throughout the day. It's at Karl Eggers with a K and 2 S's. We are also on iTunes, we're on Facebook, and we're on Google Plus as well. I hope you guys have a wonderful, restful weekend, and we will talk to you soon.